And welcome. Thank you for joining us in this webinar. The retail real estate market has undergone significant changes since COVID-19. As consumer preferences evolve, shopping centres have had to adapt, providing new ways for the community to engage. These changes can be seen through the evolution of the goods and services being sold and by the addition of what's called mixed uses, including office, residential, education and healthcare. This changing landscape provides an excellent opportunity for wholesale investors searching for income and real asset exposure in their portfolio. Hi, I'm Marty Switzer, CEO of Associate Global Partners Limited, AGP, and with me today is Ben Finger, the Managing Director and Co-Founder of the Haben Property Fund. Now, before we begin, some brief housekeeping and a message from our compliance team. This is a live and interactive session. If you've got any questions, you can submit them in the question box on the control panel on your screen. We'll aim to get to all questions today or before the end of the session, but if not, someone will give you a call. And the webinar will also be recorded, so you can watch it in your own time on demand. And finally, this webinar is for educational purposes only and is of a general nature. It doesn't constitute advice. It mustn't be acted on or relied upon. And the presentation is not an offer, a recommendation, or a solicitation. And now it's time to start the webinar and welcome Ben Finger. Ben, welcome.
Thank you for having me, Marty.
For those in our audience who aren't familiar with Haben, can you tell us a bit about the business, your philosophy, and how you invest or your investment process?
Yeah, absolutely. So Haben, as a business, was formed by myself and my father, Harold and Ben. That's how we got the name.
Hey, Ben.
Hey, Ben.
Yeah.
We came together about 16 years ago. We're working privately, doing our own projects, family projects, in an array of commercial arenas as well as residential, and we were effectively approached by some friends and family that wanted to co-invest with us, which is always a great compliment.
Yeah.
And so quite organically we moved into the funds management space, and when we went into the space, we decided that we wanted to be an expert in one area rather than try to be good or okay at a bunch of areas.
Yeah.
And we landed on what we call food and service-based shopping centres for two primary reasons. One, it has a very reliable cash flow being linked to food and services. And two, the neighbourhood or food-based shopping centres sit on very large parcels of land. They're all mixed-use zone parcels of land, and therefore they offer a lot of development upside by way of mixed-use opportunities. And for us, it enabled us to deploy our development expertise, which gives you the really big value add on the investment. So you get the cash flow along the way, which is very reliable, and then you get the upside by way of the mixed use opportunities.
You just defined mixed use and what we mean by that?
Sure, so mixed use effectively is every type of property use.
Yep.
So whether it be residential apartments that we get approved on it, whether it be commercial opportunities, medical uses, and in some cases, it also enables you to do light distribution. So if you think about that asset class, it really is the only asset class that enables you to do all the different types of uses, which is why it's so compelling for us.
Can you tell us about some of your previous investments and what they've actually achieved for investors?
So we're very proud to say that on exited funds today, we've achieved an average IRR north of 23%. That's across 4 exited funds. In each of those cases, we were able to attribute what we call an extraordinary outcome because we were able to unlock that extra value by making use of the surplus land. Now, in each of those, it didn't necessarily mean, in fact, in almost all of them, that we built what we got approved, but just by getting the approval itself. So we've got if I step you through that, so we've got the shopping centre, we improve the asset itself, whether it be through tenancy remixing, maybe slight expansions, renewing leases to giving it a longer WALE, making it more appealing from an investment perspective. That's sort of step one and what we would call the underwrite of the investment. And when we market these investments to our investors, that's all we're effectively marketing. We're marketing a lower return, a base case.
Yeah.
And we're not saying we're going to get this extra outcome. That's what we call the blue sky, and that's above and beyond expectations.
Yes.
But that's really what we try to do from day one, is to achieve above and beyond expectations. So in those cases, in those exited funds, we were able to achieve that. we got significant approvals on those sites, and I can talk of a recent one that we exited last year, which was a site that we bought in Western Sydney, where we ended up getting an approval for 600 units on the site.
On top of the shopping centre?
On top of the shopping centre. And the acquisition price, which enabled us to achieve such a great IRR, effectively took into account the value of those 600 units, and therefore we got a great outcome for the investors.
Excellent. Now, the current market conditions, can you give us your sort of views on them and how that's impacting the way you're investing at the moment?
Yeah, so 2022 was an interesting year for all. And as a business, we really sat on the sidelines for the first half of the year. There was a lot of uncertainty on where interest rates would go, what sort of impact that would have on the investment market. So we really did a lot of sitting and observing at first. When we made the decision that we wanted to invest and go in, and I have to say that as a business we are opportunistic, and we've often made our best acquisitions when we're buying when other people aren't buying. In this particular case, we wanted to make sure that we were buying something that had enough cash flow to weather the storm of interest rate increases, as well as buying something at a price that we felt was a deep enough discount that even if the market went worse, say in 2023, which is where we are now, we were comfortable that in the long term we're buying this asset at a really good price. So that was our approach to the acquisition of Forest Hill.
Okay, which we'll talk about shortly. But before moving on to that, and we're very interested in that, I should say, but obviously times have changed in sort of residential real estate on the back of COVID, the growth of e-commerce.
Yes.
What are shopping centres like the ones that you run doing now to compete?
So I think I'd make a clear delineation up front in that we really focus more on what we call food and service-based shopping centres versus, let's call them, discretionary shopping centres, which are the likes of, for better lack of description, a Westfield, where you walk in and it's all fashion shops. Yes, they have food and yes, they have services, but by and large, you're talking about an asset that, might be 80%, fashion-led and entertainment-led. We're buying, the inverse of that. We're sort of like 80% give or take, food and services, and then 20%,
more staples.
Correct, exactly. So e-commerce has penetrated the market. There's no question about it. It's here to stay, and it definitely will continue to grow further and penetrate further. But I will say this. Bricks and mortar is here to stay. There is no question bricks and mortar is here to stay. Bricks and mortar will always be the predominant way of shopping. But the sector that we focus in, e-commerce has even a lesser of an impact because it is food and it is services and it is the beauty parlour and the hair parlour and your massages and your gyms and all those things, medical centres, pharmacies that people go in. And what we can see from the numbers, and we get all this data through traffic counters in our centres, and I was just this morning sitting with my management team looking at the data, and we can see the spike in foot traffic numbers is enormous compared to this time last year. So people are very happy to get back out there, very happy to spend inside the shopping centres again. We can see sales have gone up. And anecdotally, we meet with all the retailers, the apparel retailers, the food and service retailers, the big national brands, and the feedback from them is that yes, in COVID, online, and we're talking about apparel now, did spike because people couldn't go to a shopping centre, and of course they bought online. That number's dropped back significantly, and they're having huge sales growth out of their bricks and mortar stores. And again, saying the same as what I'm saying, people actually prefer the experience. So yes, it's really what the market's calling omni shopping. People will shop in the store, people will shop online, but by and large, it's going to be online. And
Omni retail.
Correct.
Before we go in to talk about Forest Hill, can you give us just a quick summary of what you look for when you're acquiring an asset?
So for us, coming back to the origins of Haben, it's all about that reliable cash flow. So we'll analyse an asset, quite heavily, and by that I mean we'll go in tenant by tenant to actually understand how they perform and what the competition landscape looks like. So for us, when we look at an asset, we want to know that we've got an asset that has the right tenancy mix, or the ability to have the right tenancy mix if it hasn't been leased out correctly by the existing landlord. The right location, because location, of course, you can never change. Once you've got it, you got it.
Locked in.
And the right land parcel, because if it's too built out, that won't enable to be able to do anything extra.
Yes.
Or if it's not in the right location where you don't think you're going to get any extra height in the future, again, you're sort of somewhat landlocked. So for us, we look at sites that will provide that value add opportunity, because we are a value add business. We want to be able to come in somewhere, improve the asset, and sell it in the future in a better position than when we bought it in the original acquisition.
Okay. So you're currently in the process of acquiring an asset, which we mentioned, the Forest Hill Shopping Centre in Melbourne, Victoria.
Yes.
Can you talk us through that and what attracted you to this asset?
So Forest Hill really ticked the boxes for Haben as a business. In the outset, we know we were getting this at a big discount to replacement value. If you had to buy the land, it sits on a 10 hectare site, 18 kilometres away from the CBD, and build the shopping centre today with all the improvements that are there, the car park, travellators, lifts, shops, everything, you'd be paying a significant greater price to what we're actually acquiring the site for.
Yep.
There's a huge difference. So we know at the outset it was really, really good value. The asset, again, 18 Ks from the CBD, is right in the sweet spot of what we look for. So we're in a demographic that is a wealthy demographic. It's a demographic that has a higher income per average than the rest of Metro Melbourne.
Eastern suburbs of Melbourne.
Correct,
Yep.
Eastern suburbs of Melbourne. It's got a higher percentage of home ownership. So when we think about, starting at the back end, that sort of upside opportunity, we know we're in the right spot. We've got the right land size. We know there's extra land that hasn't been developed that we can develop. We're in an area that, is ripe for future redevelopment in terms of, upside opportunity by way of mixed use and apartments that could be approved
Yep.
and built, whether built by us or built by someone else. At least we can get the approval on it.
Yep.
But then the shopping centre itself, in reality, it's been somewhat neglected over its last two sets of ownership, and that's where we see a lot of opportunity to come in and improve the tenancy mix. There are some parts of the centre that work incredibly well, and
Big name tenants.
Oh yeah, you've got obviously Woolworths, Coles, Aldi. You've got your three supermarkets, which is a really good indicator. When all three want to be in the same centre, that just tells you about the strength of the grocery market there. You've got a great Asian grocer, all your good sort of staples in terms of services. It has an entertainment precinct which sits on the upper level with very limited competition within the trade area, and that does incredibly well. But it's that mid-level which is where we see the value add opportunity, where we can really sort of add our flavour to it. Remove a couple of the tenants that we think aren't great performers, and that's really what it's all about. We look at each of those tenants and understand how their performance goes, and if they're not adding their value to the rest of the shopping centre, it's not just about collecting income from them, it's about, well, you need to be doing a better level of performance, because if you're performing better, you're going to bring more foot traffic to the shopping centre, and if you bring more foot traffic to the shopping centre, there's a great flow-on effect for the rest of the asset. Yeah. So this asset really ticked the boxes for us.
Excellent. Now, mate, before we close, why do you think investing in retail real estate makes for a compelling investment opportunity in terms of growth and, importantly, income?
I just think it's and not every asset is the same, but by and large, what we look at, these assets are a fantastic hedge because you've got your food and service based tenancies, great reliable cash flow, and then you've got that mixed use opportunity. So you get the best of both worlds there. So you get that value increase as well from the potential residential uplift, and you can't find that on any other commercial asset. If you look at industrial, and look, each of the asset classes have their own merits, but that doesn't offer that opportunity. And likewise, if you look at commercial, again, it doesn't have that type of opportunity. And always you've got to look at where you are in the cycle. At the moment, cap rates are incredibly low in industrial. Again, they're good investments, but it's very different. And commercial itself is going through its own reworking with people working more from home.
Yes.
So when you look at the pricing of these different categories, retail is priced incredibly well, and it offers a stable cash flow and the opportunity for that upside. And that's why we're heavily invested in this asset class.
Ben, thanks for your time. If you would like to know more about this investment opportunity, you need to be a wholesale investor. And if you have questions about the Haben Property Fund, you can call our team on 1300 052 054, or you can email us invest@associateglobal.com or go to our website. Thanks again for joining us. I'm Marty Switzer. Talk to you later.